Hey folks, welcome to a product review at Finominal. Today we're not going to analyze a single fund, but rather three of them, and all three from RAFI. Now, RAFI is the kind of like index division of Research Affiliates, which is the firm founded by Rob Arnold, and that has greatly contributed in terms of research to the investment community over the years, which we're grateful for. And they're well known for making the point that kind of like indices do not need to be weighted by market cap. They can also be weighted by factors, single metrics like sales and profits. And so there's like these three products over here. One of them from Pimcode, the other two ones are from Invesco from a distribution perspective, where the underlying indices are constructed by RAFI. I don't know these products very well, but let's have a look at terms of what makes them tick in terms of how they have performed. And we're going to use our asset comparer tool, where we're going to first focus on the current portfolios. So this is a holdings-based factor exposure analysis. And I'm going to use the Russell 1000 index as a benchmark because all three ETFs focus on kind of like mid to large cap US stocks. Now, what we do see that based on a variety of metrics, valuation, market cap, growth, momentum, volatility, and quality, all these three funds are almost at the same position as the Russell 1000, which means these products offer very similar portfolios. The only exception is that the product from the Invesco RAFI strategic ETF, IUS, that it has a slightly higher average market cap than the rest of the products. So that's something worth keeping in mind. Now, we can also do a returns-based factor exposure analysis. I do see that, well, they all are equity products where the highest betas to the market itself, but we see consistently positive exposure to the value factor in all three products, two of them to the momentum, another two to the volatility, all three are negative to quality, and all three of them have positive to the size factor. Now, the perhaps most surprising aspect is that we see negative betas to the quality factor, but that can be explained by RAFI just taking different metrics for quality. We use a combination of return on equity and debt over equity, but if RAFI selects stocks on different quality metrics, for example, earnings volatility or earnings consistency, you might get a negative beta here. Now, having said that, this confirms that these products are very similar in terms of factor exposures, either if you can take the current portfolio, like we've done with this holdings-based factor exposure analysis, or with this returns-based factor exposure analysis. We can also look at the overlap in terms of number of stocks. So we do see that these are very broadly diversified portfolios because they represent indices ranging from 544 stocks to 1,010. And you can see that the overlap between these ETFs is quite high. So, for example, MFUS and IUS, there's this 76% overlap in stocks. Another way to look at this is simply looking at the correlations. And we can see, for example, MFUS has a correlation of 0.96 to PRF, which is quite high. And you can see still a very high correlation to IUS. Now, so these products are quite similar in terms of underlying portfolios, in terms of strategies. Let's see how they have performed. And so we have data going back to 2018 for those three ETFs. And what we do see is that effectively only one of them, which is IUS, has effectively beaten the Russell 1000 index. Two of them have underperformed. You can also again see that the MFUS and PRF, i.e. the blue line, the green line, that they're very similar, which just confirms this high correlation of 0.96 that we've seen a second ago. Now, this is from a performance perspective. Naturally, we should also look in terms of from a risk-adjusted perspective. So what we do see that the index itself, the benchmark that we've chosen, the Russell 1000, has generated a Sharpe of 0.64 over the last 6 years, versus MFUS as well as PRF have generated lower Sharpe ratios with 0.57, 0.56. Having said that, IUS has generated a higher Sharpe ratio, 0.72, which is a big difference to the index for these other two products. And we can attribute that to one's higher CAGR as well as lower volatility. And that's actually great. Now, question is, can we explain the better absolute performance as well as the better Sharpe ratio of IUS versus the other products or the index? And kind of the most obvious explanation would be the larger market cap effectively here, which simply tilts this more towards the S&P 500 rather than the Russell 1000 index, because the average market cap is higher than for the other two products or the benchmark. And so this kind of concludes our analysis of those three ETFs. In general, it's kind of it's very difficult to differentiate them, as you can see. You could almost look at them as proxies of each other. There's naturally a question also from a fee perspective. You could look back and say, fine, IUS has generated the highest Sharpe ratio and the highest return, but 6 years is still on the short side, and this might be more, well, luck than skill or something unique in the index construction. And from our perspective, we can, well, look at them as similar enough to be taken as substitutes to each other. Hope that helps. Have a nice day.